investing activities. And I promise I will give a simplified one for this because it was a little bit tricky. Okay, this one was a little tough. Yeah, I'm not gonna lie, when I looked at it, I was like, okay, it's not bad, and then when I kind of went to review it, I was like, okay, it takes some analyzing the T accounts to really understand some of the changes in there. Okay, so again, comes to the midterm, make it a little bit more straightforward. Okay, but here we have, okay, equipment. Okay, we went from 230,000, okay, to 300,000. Okay, and then it also says the equipment sold originally had a cost of 74,000, and we sold it for 15,000. Okay, so I'll do a T account over here. Okay, so we had, okay, starting piece for equipment. What was it? 230,000. Okay, now I can't see it. Yes, 230,000 to start, right? Okay, so our beginning was 230,000. Our ending was 300,000. Okay, so that's what at first you think, okay, must be $70,000, right? Okay, that's not the case here. Okay, because it says here, the equipment sold it originally cost $74,000. So it's sitting on our books at $74,000. Okay, so when we sell equipment, okay, we would typically get, okay, cash, and we credit equipment. Okay, it gets a little more complicated than that, but for this example, that's fine. Okay, so cash is increasing, it's an asset, so we debit it. Equipment, it's an asset, we're selling it, so we're removing it from our book value at $74,000. Okay, so if we sold it for $74,000, okay, then we need to put the credit here.
We sold for 15.
Yeah, so we sold it for 15, but it's sitting at our books. We have it on our books at 74,000, but we only get 15,000 for it. Okay. Oh, I see what you mean. Okay, 15,000, and then we would have, okay, it would be loss on disposal, okay, for the difference there. Okay, so yeah, that's what I mean. It gets a little more confusing because there's depreciation, so not the best journal entry for it, but we're reducing our equipment by, okay, 74,000. Okay, so when we reduce equipment by 74,000, okay, we can say, okay, 230,000 minus 74,000 equals what? Okay, 230,000, okay, minus 74,000, right, 156. Okay, but it says on our balance sheet, our ending is 300,000. Right, so what must we have done throughout the year? Right, we must have bought new equipment to get to this 300,000, right? Okay, so that's what, okay, X, okay, would equal, okay, 144,000. So that's, okay, new purchase. Okay, so that's the tricky thing, saying, okay, we must have bought $144,000 worth of equipment. Okay, so when our cash flows from our investing activities, okay, we're going to take a look. It's going to be, okay, less, okay, purchase of equipment. Okay, it's going to be, okay, 144,000. Does that make sense to everybody? Kind of like we haven't really got into the depreciation calculations and how to sell an asset. Okay, but again, if you follow the T accounts, we start with 230,000, we sell an asset for 74, and we end up with 300,000 at the end. Okay, the difference has to be, we must have bought something. Okay, so that's how they did that. Again, when it comes to a midterm, I'm not gonna give you a puzzle to solve. Okay, I'll make it a little bit more straightforward, saying, okay, maybe we bought equipment for X amount throughout the years. Okay, simplify it a bit more. Okay, but good to kind of see how the process works, I guess, I don't know. Okay, next up, okay, did we sell anything? Okay, equipment originally cost 74,000 and it sold for 15,000. Okay, so any cash inflows from investing, right?
Yes.
Should be the 15,000, right? Okay, so add date sale of equipment here. Okay. Anything else? Any other investing activities? Okay, this balance sheet's okay, doesn't have a whole lot. We don't have to do anything with accumulated depreciation. Okay, that's really the only assets that we own. Okay, so we bought equipment, okay, for 144,000, sold some for 15,000. Okay, so that's what our net cash from investing. Okay, so what's 144? Is that 129? Okay, counting on my mental math.